your question about the gold-silver ratio, I think we're going to see it fall further. I think we'll see it fall quite significantly. I mean, I wouldn't rule out at all. In fact, I would expect it to move back down to around about 50, which has been some sort of average over, really since about 1900, I suppose, or the 1880s. Because it was in the 1870s when silver was no longer, the silver standards, if you like, no longer applied in Europe. The last one being Germany, which went on to a gold standard, I think, in 1873, thereabouts. That meant that the value of silver was then being priced for its next use. And so the gold-silver ratio from that point rose from 15, 16, whatever, on the way up. And of course, it peaked under President Trump in his first term in office at something like 120, and is now on its way back down again. And this is particularly important because if I'm right about the relationship between gold and precious metals, then we are going to see silver recover very substantially, and not the only one, even measured in gold. Of course, everybody concentrates on silver because that is if you like, the second most important monetary metal in the absence of fiat currencies. So, you get loads and loads of bulls, if you like. So, pessimists like me thinking, if we're going to have a currency crisis, or it's the end of the fiat currency era, then silver's going to come back. I think that will probably fuel some speculation, but I think the main point which everybody is missing is that it's not just silver, but it is all the other base metals which have been suppressed by the fall in the purchasing power of fiat currencies. So much so, they can even quadruple against gold just to return to normality. And what does that mean if gold continues to rise against the dollar? In other words, the dollar continues to fall, pushing gold-dollar values even higher. Well, it means that when it comes to inflation inputs, if you want to look at it in more conventional economic terms, those inflation inputs are going to be very destructive of fiat currencies, horribly so. That's the future, I'm afraid. And what does that mean for bond yields? Oh, up, 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 up. And it's got nothing to do with the collapse in economic activity that will happen. That's going to happen. Partly because of the adjustment, but also because of the past history of suppressing interest rates and the accumulation of unproductive debt. They're missing the most important thing, of course, which is against what? Okay, in real terms, but it's already it's already suppressed in gold terms, which are real terms. And then when you put an overlay of a devaluing, debasing fiat currencies on top of that, then measured in those, it's gonna, this is a disaster. It really is.
And why do you think it's been suppressed then for so long?
It's a function really of the fiat currency regime that really has been in place ever since 1933-34, when gold, in early 1934, the dollar was devalued by 40%. In other words, the gold exchange rate was raised to $35 from 20.67. That sort of held all the way through to 1970, when finally the expansion of the monetary base, if you like, the expansion of unproductive dollar debt really meant that the relationship at $35 became virtually impossible to maintain. I mean, and bear in mind also that the Americans had reduced their holdings gold from 1947-48 from, I think, something like 21,000 tons, 22,000 tons, down to 9,000 tons in 1971, when finally they threw in the towel on the gold standard, or what sort of passed for a gold standard. And since then, we've had a fiat currency. It started off with the US Treasury going on a propaganda campaign saying, gold is no longer the, if you like, the standard. We went from a fixed exchange rate regime to a floating exchange rate regime. The dollar was the king currency. Okay. And it sort of got to the point where, this rubbish, this propaganda was so believed that they were even describing gold as a pet rock. It's no longer part of the system. But the interesting thing is that now nobody's talking about gold at all. We just don't want to talk about it. We don't want to talk about it. But as I say, you can go back to the Emperor Diocletian, who introduced an edict of maximum prices. That was around about 270 odd or 300 AD. A long time ago, 1700 years ago plus. You can look at those prices. Okay, the slave markets no longer operate, so there's no comparison there. But you look at things like, beer, wine, clothes, all these things, they're similar price today, measured in gold. The thing that's changed, of course, is that currencies come and go. And every one that comes, goes. Because what's currency is credit. And eventually, the credit becomes worthless, or it becomes questioned, and it has to die. That's what happens.
When we speak about the purchasing power of gold, we're not discussing an arbitrary number on a chart. We're talking about an anchor, something that has outlasted every government, every fiat experiment, and every school of Keynesian fantasy economics. Gold has retained its purchasing power across centuries, not because it's shiny or because central bankers say it should, but because it is the only form of money that is not simultaneously someone else's liability. That truth becomes ever more apparent in a world drowning in debt and denial. Now, of course, prices of individual commodities will vary when measured in gold. Some will rise, some will fall. Technology changes, minds are exhausted, tastes shift. That is the nature of a dynamic world. But what doesn't change is the average purchasing power of gold across a diversified basket of goods, especially base metals. Take copper, tin, nickel, lead. When measured in gold over the last 150 years, their purchasing power has been astonishingly stable, save for brief periods of war or policy distortion. In contrast, the dollar, well, that's another matter entirely. Since the Fed's creation in 1913, the US dollar has lost roughly 97% of its purchasing power. Imagine losing 97% of anything and calling that a success. Let me walk you through a historical case. Back in the early 20th century, when the dollar was still on a gold standard at $20.67 per ounce, a gentleman's suit cost about 1 ounce of gold. Today, with gold trading near $2,400, a high-quality suit still costs around that amount. But the dollar, it's buying you increasingly less. You see the problem. What gold tells us, what it always tells us, is that the currency measuring stick is broken, not the price of the goods being measured. Consider the period from 1950 to 1970, when the US dollar was supposedly fixed to gold at $35 per ounce under the Bretton Woods system. During that time, dollar credit expanded far faster than gold reserves. This set off a pressure cooker that eventually exploded in 1971 when Nixon closed the gold window. Why did he do it? Because the gold was leaving the vaults. Foreign central banks saw the writing on the wall and wanted the real thing, not promises. France under de Gaulle even sent a battleship to retrieve their gold. Yes, a battleship. That's how serious gold was. It still is. And what has happened since the end of Bretton Woods? The purchasing power of the dollar has fallen off a cliff. Yet central bankers will tell you inflation is well anchored. Anchored to what? Delusion? CPI measures are manipulated, hedonic adjustments abound, and asset bubbles are now the preferred economic stimulant. But here's the uncomfortable truth. Gold has not risen in value. Fiat currencies have fallen. And when you strip out the distortions and price suppression schemes, the real value of gold in terms of what it can buy remains roughly constant. Meanwhile, base metals, measured in gold, have declined 70% from their 1900 levels. Let me repeat that. 70%. That's not efficiency, that's a warning. In fact, base metals have so underperformed when priced in gold that we're now looking at a potential 400% increase in their value just to return to historical norms. And if fiat currencies continue their descent, which they will, then the nominal increase in dollar terms could be dramatically higher. That's not a gold bull market, that's a fiat death spiral. Now, Keynesians will argue this is all just supply and demand. They don't understand purchasing power as a dynamic concept. They believe that demand falls in a recession, and so prices must fall, but they ignore the other half of the equation, the value of the currency in which prices are measured. That's the elephant in the room. When fiat money loses credibility, prices rise regardless of economic activity. It's not inflation, it's repudiation. And it is coming. Look around. Inflation inputs are quietly entering the system through the back door. Despite widespread concerns about recession, commodity prices are beginning to firm. Why? Because investors are slowly realizing that fiat currencies are not a store of value. They are political instruments. And politics is a notoriously poor compass for monetary stability.
The purchasing power of gold is relatively constant. Now, obviously, individual commodities, some will rise and some will fall. There will be differences, if you like, because of